Data today from retail sales, from PPI, it feels like we are seeing that deceleration, except much slower than previously anticipated. What do you make of the market reaction now pricing in 100 basis points of cuts by year end from the peak policy rate this summer?
Well, I think I know two things in this life. One is that markets tend to overshoot, but markets are forward-looking, and so I think in that instance, we know the fundamentals would dictate slightly higher interest rates for the U.S. economy and some others, but the volatility we see can be a drag on growth. So if they do see a pause, it would have to be to reevaluate. I think the burden for cuts is high, and so I'm somewhat skeptical of the term structure. Things would have to get materially worse and start significantly downgraded economic growth forecasts, I think, for that future to materialize, at least in short order.
Well, let's take it to across the Atlantic and go actually about the ECB. Shonali Bassig, our Wall Street correspondent, was just talking about the commentary we might hear off of the kind of news coming out of Credit Suisse. What could change the game from the European perspective?
Well, again, I think the bias is to tighten. I think, and what's always a tricky line to walk is to separate as best you can liquidity concerns in the market from solvency ones, right? Because solvency can ultimately lend to, gets more at the heart of economic growth, enhanced financial, price stability, and all those things that central banks are using the policy rate for. So when it's not clear, I can hear, reasonable people disagree about pausing for a time until you can get a better picture. But I still think the bias is towards normalizing policy because you have a labor market that is still too tight and inflation that is still too high. I think, again, market conditions would have to get worse, and it would be the reasons why they are getting worse that would be informative for policymakers.
Well, let's bring it back then to some of the data we've gotten in the last couple of days. I really want to focus on the CPI. You mentioned the labor story. We're still seeing extremely hot payrolls numbers, but it feels like on the housing front, for example, which was the other sticky piece of inflation, you are seeing that deceleration. Are you worried at all about some sort of pop of a housing bubble?
I'm not worried about a pop in the sense of, I think we're continuing to see rebalancing. There's still a great deal of pent-up demand for home construction. That's why payrolls and employment in the construction sector has held up. Nevertheless, we will see that will be housing will be a source of disinflation over the course of the next year. But it gets back to, I think, ultimately what carries the day is the strength and tightness of the labor market. We will see a disinflation, but it will come at some cost. And I think that's what the market is starting to wake up to. It was unlikely we were ever going to have inflation come back down to 2 without any ramifications of some subpar economic performance. And I think we're seeing some appreciation for that.